Do you think you know the right time to pay your taxes? Well, by the end of this video, we're going to give you all the information you need so that you don't pay at the wrong time. Welcome back to Navigate Your Wealth. I'm Karen Stawicki.
I'm Samantha Irish, and for the best advice on how to use both life insurance and annuities to have the most successful retirement, subscribe to our channel. And don't forget to hit the notifications bell, that way you don't miss any of our new videos. Everyone wants to know, should I pay my taxes now or should I pay my taxes in the future? It's a question that we are always working with our clients to try to figure out. And for years, you told your clients, kick the can down the road, put as much into your 401k or IRAs as possible because you'll be in a lower tax bracket when you retire. And in most cases, for those clients, when you started in the 80s and 90s, that's great advice. It's working out perfectly for them.
Top marginal bracket was 70%. A married couple earning $100,000 was in the 59% bracket. So now pulling the money out at 25 or 30% right. Makes total sense. But that's not the case today.
Well, and for those of us that are putting money away at 20, 30% with the potential for it to be higher in the future, are we doing ourselves any favors?
Well, and you're also going to be making more money, I would guess. Mm-hmm. For those of you watching that are coming in and you've just gotten into the workforce, so you've been in a few years, you know your potential. You're going to get raises. First of all, you have to get raises. And so with those raises also will be higher tax brackets. So you're probably not in your lowest tax bracket today.
So the idea of kick the can down the road, pay taxes in the future, you'll pay less tax, may be something that we need to reconsider. Are we being the most tax efficient with this decision? But if we go with we need to maybe pay it now, the question is, should I even contribute to my 401k?
Well, one thing I will tell you about should I contribute to my 401k is there's a really good rule, and it's called take the free money. If your company offers a match, you've got to contribute up to that point at least. So if you put in 6% and they match 50%, that's free money. Beyond the 6%, you need to have a conversation with us to find out what on the tax-free side, you might be able to put the remainder of those contributions because you do need to save more than just the company match. But take the free money every time.
Okay, so you take the free money, but isn't another reason that people say that you should contribute to your 401k or an IRA is because then you have the potential to grow and earn on the contributions, the earnings, and the money that would have otherwise gone to taxes.
Absolutely. There's no question about that. But I also want you to understand something else. You are growing on those three things, not just for yourself. Those accounts, the individual retirement account and the 401k, are joint accounts with the IRS. Sorry, but that's a fact, right? So you contribute. You're earning. You're kicking the can down the road. But eventually, when you go to pull that money out, the IRS steps in. They make all the rules. They set all the rates. They take their piece first and give you what's left over. Yeah. So you may not just be getting a bigger bag for yourself. You're getting a bigger bag for them, which is why they really love your contributions because they know they're going to get more down the road.
Leave a comment in the section below and let me know if you've ever known anybody to complain about paying taxes in retirement. And if you'd like to learn how to minimize your taxes, let us know. And then after this video, check out the video that we created called How Can I Get Tax-Free Income? Where we'll talk about if you're going to pay now, pay that tax. How do you get tax-free income in retirement when you never have to pay it again?
So here's another one that I get a lot. It's just really shocking. People actually ask, do I have to take money out of the IRA or the 401k ever? The answer is yes. You can run, but you can't hide. The IRS has been very, very patient all of these years. When you're 59 and a half, you're finally eligible to draw that money out without any penalty, but there will be taxes. And so interesting, we've had clients that when they finally get to that age, don't want to take the money out. And the biggest reason is because
it's taxable.
Oh, shocking. It was always going to be taxable, but they forgot that part. So now they want to leave the money in there and not take any distributions. That's okay. Yep. The IRS says that's fine. But at 72, used to be 70 and a half, but at 72, you reach what's called required minimum distribution age, which is when the IRS blows the whistle and says, I've been patient enough, pull that money out, I want to pay the taxes.
What if you don't pay the taxes at 72? What happens?
Well, you don't take a distribution, there's something called an RMD penalty. And if you take money out before 59 and a half, there's a premature distribution penalty of 10%. But if you don't take the money out at 72, it is 50%.
Wow.
You still have to take the money out. You still have to pay the taxes, but now you have to pay a 50% penalty on top of that. So that is a really, really dumb thing to do.
It's not a good strategy, and it's not a tax efficient strategy, right? That's what we're talking about. We just want to make sure that we're addressing your total tax risk over your life. We've actually been running some webinars over the last year to really help educate people like yourself to understand the impending tax increases. What tax risk may you face in the future? Something that people don't consider is what we like to call their total tax burden. Not just the amount that you pay today, but the amount of tax that you'll pay over your lifetime.
Let me give you an example of what Samantha is talking about. Let's just assume for a moment that you have a $500,000 IRA. And instead of letting you just take required minimum distributions over your lifetime, we recommend that we do a Roth conversion of that IRA. Now, we're not going to tell you to do it all at once. Paying tax on the full $500,000 would definitely throw you into the top bracket. But let's do it over 5 years. So we're going to take $100,000 each year. The tax on that, we'll just say, is 25%. So 5 conversions, $25,000 each year, times 5 is $125,000. Now, writing that check for $125,000 is going to be painful, okay? Definitely going to be painful. But guess what? At the end of 5 years, you've given the IRS $125,000, and you never need to give them another dime. That money now in the Roth can grow. You can take it. It's tax-free. Do whatever you want with it. You can leave it to your children, your family, whatever, tax-free. All right, let's roll it back. You think that's a terrible idea. So you're going to let that $500,000 stay in that account, and when required minimum distribution age comes, 72, they're going to force you to take money out of that account. Let's just, kick you off at 90. So your RMDs and your taxes paid from 72 to 90 are going to total more than $450,000. It's not my opinion. It's math. We've seen it. We run the analysis for clients and prospects all the time. It's actually what happens. So now I want to ask a very simple question. Do you want to write those 5 painful checks of $25,000 for a total of $125,000 and be done? You got that monkey off your back. Or would you rather write smaller, potentially, checks? Not necessarily they're going to be smaller if taxes go up. But do you want to write more checks over your lifetime, knowing that the total tax burden is going to be $450,000?
Yeah.
Quick question. $125,000 or $450,000? Which one makes more sense?
If you'd like to learn how to get your tax burden analysis and find out if you may be able to minimize your total tax risk, click on the link below and apply to be our client. And as always, if you liked this video, please give it a thumbs up, subscribe to our channel, and share it with a friend. Don't keep us a secret. Remember, if what you thought to be true turned out not to be, when would you want to know about it?
Thanks for watching.